Welcome to This Explainer. Today, we're diving into how Warren Buffett built an absolute mountain of wealth. And spoiler alert, it wasn't with flashy tech stocks or timing some crazy day trade. It was through the ridiculously powerful combination of patience and compounding. Think about this for a second. What if I told you that one of the richest people on the planet made 99% of his wealth after his 50th birthday? Crazy, right? He didn't invent an app, he didn't launch a crypto coin. Instead, he built his empire by reading, waiting, buying incredibly boring businesses, and doing, well, almost nothing for a very, very long time. This is the story of the Oracle of Omaha, sure, but more importantly, it's a literal masterclass in how true wealth is actually generated.
So let's jump right in and challenge what pretty much everyone thinks about getting rich these days. How is real wealth actually built? I mean, we are constantly bombarded with this message that speed is absolutely everything, that you gotta act fast, get in early, or you're gonna miss out. But Buffett's life literally proves the opposite. His biggest investing secret isn't some astronomically high IQ or getting incredibly lucky. The real secret? It's entirely behavioral. Just think about the stark contrast between our modern obsession with action and Buffett's counterintuitive secret. The average person, they're chasing the thrill of fast money, flipping houses, jumping in and out of day trades, sitting in front of 6 glowing monitors. But Buffett's method is all about immense discipline and patience. We're talking reading, waiting, and doing almost nothing. The wild part is that pretty much anyone can copy these principles. What people really struggle with, though, is having the discipline to actually execute them. All right, Section 1, the illusion of fast money, or why speed actually kills wealth. Let's wind the clock back and look at Buffett's early life in Omaha, Nebraska. Even as a kid, his obsession was never about buying a flashy car. It was about figuring out exactly how money moves. While other kids were playing with toys, he was already scheming like an investor. I mean, he started super small, selling chewing gum, Coca-Cola bottles, hockey newspapers. He even teamed up with a buddy to buy used pinball machines and put them in local barbershops. He was intensely focused on cash flow from day one. He learned super early that if a dollar could create more dollars, time would eventually turn something tiny into something absolutely huge. But, he still had to learn a few things the hard way. When he was young, he bought his very first stock, a company called City Service. Well, the stock dropped. He panicked, like we all do, right? Actually, when it finally bounced back up, he sold it for a quick, small profit. Sounds like a win. Except it wasn't. After panic selling for that tiny gain, he had to sit on the sidelines and watch that exact stock absolutely skyrocket. That agonizing experience taught him a rule he never forgot. Constantly jumping from trend to trend destroys your wealth. The real money is made by buying something truly valuable and just holding on to it. Which brings us to Section 2, thinking like an owner, and the critical Benjamin Graham lesson. This was a massive turning point for Buffett. He studied under Benjamin Graham, who is widely known as the father of value investing. Graham completely rewired how Buffett looked at the stock market. He taught him to focus entirely on intrinsic value. Now, intrinsic value has literally nothing to do with whatever the current stock price says on your screen. It's about what a business is actually worth in the real world based on its performance, its profits, and its debts. So Buffett learned to stop looking at a ticker and asking, is the stock going up today? And instead ask, what is this actual business worth? If you want to figure out that value, you have to genuinely think like a business owner. Imagine you're buying a small local coffee shop. You wouldn't just buy it because someone on the internet said coffee is trending, right? No way. You'd ask logical questions. You'd want to know, how much money does it actually make? Does it have a mountain of debt? Do the same customers keep coming back? Is the current owner honest? And ultimately, is the asking price fair? That is the exact blueprint for evaluating a stock. If the actual business is worth way more than the current market price, you buy it. Boom. That became the entire foundation of his strategy. Moving right along to Section 3, from cheap to great, the Berkshire mistake. Now, even with that incredible foundation, mistakes still happen. And the irony here is just off the charts, because one of his biggest early blunders involves the actual name of his current empire. In the 1960s, he bought a struggling textile business called Berkshire Hathaway. Why? Simply because it looked super cheap on paper. It was just factories, fabric, and a rapidly declining industry. He took control of it, a move he later straight up admitted was a terrible investment. The lesson? A bad business can stay bad for a really, really long time. So a weak business at a dirt cheap price isn't a bargain. It's a trap, and it will absolutely destroy your money. Enter Charlie Munger, Buffett's brilliant longtime business partner. Munger basically looked at this and forced a complete paradigm shift.
Buffett's old strategy was like digging through the bargain bin, hunting for average or even struggling businesses just because they were cheap. Munger pushed him to upgrade that thinking entirely. The new strategy became about buying true quality, finding great businesses, even if you have to pay a fair premium price for them. So, what exactly makes a business great? Well, Munger and Buffett started looking for some very specific traits. They wanted incredibly strong brands like Coca-Cola or Apple. They wanted fiercely loyal customers who love the product, think See's Candies. They looked for powerful pricing ability like American Express. And above all else, durability. They were basically asking, will anyone still care about this company in 10, 20, or 30 years? This shift was a game changer. It allowed them to play the forever game, holding companies with massive long-term advantages instead of trying to guess what the market might do by next Tuesday. Okay, Section 4, the compounding machine, the engine of wealth. Let's look at how this whole operation actually scales up, because this right here is the underlying engine of Berkshire Hathaway's unbelievable wealth. To really get it, we need to talk about a concept called float. See, by owning insurance companies like Geico, Buffett unlocked access to massive amounts of this float. Think about it. Millions of people pay their insurance premiums today, and the company just holds on to that cash before they ever have to pay out claims years down the line. That giant pile of money sitting in the middle, it basically acts as massive, free investment fuel. So as long as the insurance side of the business is run carefully, Buffett just follows this beautifully simple loop to build his empire. Step 1, you collect those insurance premiums. Step 2, you take that massive float and invest it into those great, durable businesses we just talked about. Step 3, you take the profits from those investments and, you guessed it, reinvest them. And finally, step 4, you let decades of time do the heavy lifting. That's it. Berkshire Hathaway literally became a compounding machine where money earned money on a scale the world had honestly rarely ever seen. Buffett famously compares this whole wealth-building process to rolling a snowball down a hill. The rules are super simple, but they are so profound. Start early, keep going, and find a very long hill. Compounding, especially at first, looks incredibly tiny and, honestly, pretty boring. You invest your money and, well, nothing crazy happens. But if you don't stop pushing, the growth starts feeding on itself. Money earns money, which earns even more money until it becomes this totally unstoppable force. Seriously, a massive chunk of Buffett's net worth came way later in his life simply because he never, ever stopped pushing that snowball. Which brings us to our final part, Section 5, your blueprint for wealth, replicating the mindset. Now, you might be sitting there thinking, okay, that's great, but I don't exactly have a few $1 billion or a huge insurance company. But here is the incredible news. You don't need them. You can entirely replicate his behavioral mindset to change your own financial future. Here's your actionable blueprint. 1. Buy real assets, not hype. Stop chasing whatever meme stock is trending this week. 2. Understand exactly what you own. If you can't explain how the company makes its money, you probably shouldn't own it. 3. Think long-term. 4. Avoid permanent mistakes. You want to protect yourself from permanent loss rather than stressing over daily price swings. And 5. Above all else, be patient. Spend less, invest consistently, and just chill out when everyone else is panicking. It really all boils down to this one idea. Patience might just be the biggest investing advantage you have. We live in a modern world that is absolutely addicted to quick wins, fast cash, and overnight success stories. So your ability to simply wait, that is your ultimate superpower. Building wealth isn't about perfectly predicting the future or trying to look like the smartest person in the room. It is almost entirely about your behavior. The slow, boring path of patience can genuinely be the most powerful path you take. So as we wrap up this explainer, I want to leave you with a final provocative thought. The next time you look at your money or check your portfolio, I want you to ask yourself, are you a trader or are you an owner? Are you constantly chasing that next quick move, or are you